This was posted on Twitter, but it comes from B of A, and it's similar to research we've shown recently regarding the valuations, looking at an abundance of different valuation indicators for the S&P 500. This is more that they've put together than we ever put together, but I'll tell you, there's a few that we've done on our own that aren't even included on here. That like the margin adjusted PE ratio that show that we're at historic high valuations, and this is just showing that across 19 of 20 different metrics, the S&P 500 is historically expensive on a fundamental basis. What does fundamentals mean? It means relative to underlying earnings and free cash flow or revenues and all the different financial metrics by which we can say, historically over time, is the stock market cheap or is it expensive? And using this Z-scoring methodology across these 20 different metrics, you can see that on many of these, we are more than 2 standard deviations above the mean in terms of valuations. So a Z-score above 2, which you can see off on the right, means more than 2 standard deviations above the historic mean for these valuation metrics. So what are some of the ones above 2? Trailing PE, the Shiller PE, which is the Shiller CAPE ratio, 2.4 standard deviations above the mean. That margin adjusted, Shiller style CAPE ratio is something that we've shown that's also way more than 2 standard deviations above the mean. Price to book values, EV to EBITDA. These are all things that we have shown as well. But it's just nice to see other, big investment firms like B of A, Merrill Lynch, highlighting these things as well to their clients. There's a lot of risk out there in the marketplace. Price to operating cash flow, more than 2 standard deviations above the mean. EV to sales, and whether it's there's one unique one here. I think Tavi would appreciate something like this. The S&P 500 in WTI terms. What's WTI? That's crude oil. So S&P 500 in terms of U.S. crude oil, 2.7 standard deviations above the mean. And one that I featured a lot in some of my own research, and it's kind of the Warren Buffett indicator, but S&P 500 market cap relative to GDP, 2.9 standard deviations above the mean. Look, across a number of different valuation metrics, the S&P 500, large cap stocks, mega cap stocks are historically expensive. And this is a risk. This is a big risk. Let's go on to the next. So this is just highlighting again the chart that I've shown, looking at the Magnificent Seven mega cap tech stocks. Again, this Warren Buffett style of valuation measuring, looking at enterprise value as a percentage of GDP. The Mag 7 stocks, recently got up to 62.5% alone, just these 7 stocks of EV to GDP. I believe this is an historic bubble. How do we know? Because we look at the same metric and go on to the next slide, and we compare it to the tech bubble. A lot of people think valuations were even higher in the tech bubble. Well, not for the mega cap tech stocks. They were, these were some big internet bubble stocks. It wasn't just the .com. It was also Microsoft and Cisco and Sun Microsystems and AOL, et cetera. And when you looked at and these were big multinational companies with earnings and free cash flow. And people say, well, in the tech bubble, these companies didn't even have earnings. Well, that was some of the .coms, sure. But these were big companies with earnings. We only got to 30% of EV to GDP at the peak of the tech bubble. We are more than twice as overvalued when it comes to the top heavy mega cap tech stocks today. And I think this is a huge risk. I think this market is at risk of a significant correction. sure, we've been saying this for a while, and we haven't had it yet. We've seen little fits and starts, but we haven't seen anything yet. I believe we're still going to see it. Let's go on to the next. So what's one of the big problems that we have today? We've been talking about this a lot. Tavi's been talking about it a lot, and it's the U.S. interest payments that are such a huge component of our deficit problem that we have here in the U.S. Deficit to GDP is close to 7% of GDP. Yes, the new Trump administration is trying to get that down, and our new Treasury Secretary, Scott Bessent, is trying to talk it down, and they have a number of policies to try to get it down over time. Whether it's the deregulation or the energy policy with increasing energy production and trying to get inflation expectations down by producing more domestic energy, or whether it's DOGE and all the spending cuts that they purport to be able to get through. Trump was just was just talking today on Bloomberg. I just saw him, and he's talking about maybe we can save $500 billion, maybe we can save $1 trillion, maybe $1.5 trillion. But this is a lot of talk that's out there right now, and some good ideas. But you'll note that well, first of all, this chart is just showing that right now, net interest expense, according to the Congressional Budget Office, is expected to, has just crossed the defense portion of the budget as a percentage of GDP, and it's projected to increase. This is not what Secretary Bessent and Trump are trying to tell the world as they're trying to talk down the entire curve, the entire interest rate curve. Focus primarily on the 10-year. And they've had some success with 10-year yields coming down a little bit and talking it down, but we're nowhere near the level of interest rates that we need to get to where net interest outlays are not a substantial portion of our budget and our budget deficit. We don't want to be where these lines are projecting, but there's a problem because what's it really going to take to get interest rates down to a level where net interest outlays can be less than defense spending? It's going to take a lot of work, and we're simply not there yet. And you'll note that Scott Bessent recently has been making a point of saying that this is going to take time. This is going to take a lot of time for these policies to have an impact. And so what is going to happen in the short term, as it takes a lot of time for these policies to have an impact, because we have some major imbalances right now that have to be dealt with. Let's go on to the next, which may be my final slide. Or maybe I have a couple more, but look, so one of the key problems is inflation expectations, and you'll hear that even Scott Bessent and you'll hear the Trump administration start to talk about how the inflation expectations, which are still high out there and still a problem, are leftover problems from the Biden administration. And we know the Biden administration created a lot of inflation. Where during COVID they provided a tremendous amount of stimulus, printed a lot of money through the Fed, and provided fiscal stimulus at the same time as we had supply constraints and supply problems. And so, like Bessent, I think, implied recently, you increase demand, and you amidst all these supply constraints, you're going to have inflation. But he said it's going to take a long time for these imbalances to get resolved. Well, the Michigan survey came out again today, and this was from a month ago, and I apologize, I haven't updated it again today. But the mean 5 to 10-year inflation expectation among people, among the U.S. population that is surveyed, still came in way above 6% today. And in the Michigan survey, the consumer sentiment also disappointed again today, meaning that inflation is still a big problem. So how are we going to get interest rates down if inflation and inflation expectations are still a problem? And is it really viable that these three pillars of increasing energy production and deregulation and Doge potential spending cuts are going to be the trick to get inflation? I mean, maybe over time, but but we don't have a lot of time, because the deficit problem is staring us right in the face now, as that Congressional Budget Office chart showed. Do I have another slide, Trevor? Is there one more, or was this my last? Okay, well, let's just back up for 1 second so I can finish up then. So look, my contention is that we need a major stock market correction, that the Trump administration needs a major stock market correction. And I think that is the quickest path to get inflation expectations down. And I think that's still the biggest risk in the marketplace. I think this is something that is still ripe to unfold. And like you're hearing Scott Bessent, talking more about how it's going to take a lot of time and blaming the lingering inflation problems on the Biden administration, a major stock market correction early in the Trump administration could be blamed on the Biden administration for creating that bubble in the first place. And it would be, I think, the best thing for this new administration. So, the risks are extraordinarily high. We are positioned through put options in our global macro and long short funds. You'll note I talked about it last week, our negative downside capture ratio in the global macro fund. What that means, that historically over 19 years, our global macro fund has gone up on months on average when the stock market has gone down. Why? Because we're not afraid to be different. We're not afraid to be contrarian value investors. We are actually a hedge fund. The global macro and the long short hedge funds are actually hedge funds that go short. So we have short positions where we take contrarian stance in long positions like gold and gold mining stocks. And, I think, a little bit different positioning like we have now compared to the market at large, which is overweighted in S&P 500 long strategies and passive strategy. I think it's time to be looking at something different. And that's what we offer here at Crescat.